Welcome to the Power on Heels Fund Incorporated as we present this virtual masterclass as part of our series of the COVID-19 Financial Summit, Reestablishing Financial Security, AIM, the Crisis. I am Ivette Mayo, the founder and CEO of Power on Heels Fund Incorporated and the CEO of Yo Soy I Am LLC. Power on Heels Fund Incorporated is focused on minimizing the impact of gender pay gap inequity and the advancement of Latinas in the marketplace by providing specialized training programs, mentorship, and scholarships that are designed to enhance the earning potential, accelerate professional growth, and cultivate future leaders. Stay connected to Power on Heels on all our social media platforms, and please visit our website at poweronheelsfund.org. Stay informed and stay plugged in. There you can have all the information on our current events and all our efforts. The COVID-19 Financial Virtual Masterclasses are filled with industry experts and change agents sharing information to help you create smart financial strategies during these difficult times. Following reliable information and sound fact-based advice will go a long way in helping you achieve your financial goals. Remember, your financial mastery is about how you live and lead. For this virtual masterclass, you'll have the opportunity to receive valuable information from a powerful change agent. We'd like to welcome Steve Mills, President of American Best Credit and Debit Consultants, LLC. Welcome, Steve.
It's my pleasure to visit with you today. My name is Steve Mills. I'm the President of America's Best Credit and Debt Consultants. My wife, Claudia Ariano Mills, is the CEO and a member of Power on Heels, but she's not feeling well, but we definitely want to participate in this event. So I'm sitting in for her. We want to talk about the effects of COVID-19 on personal credit, and we're going to talk a little bit about credit in general. To a lot of people, the whole credit industry is a bit of a mystery, how it works and how it's being affected by the current state of affairs. First of all, there's three types of credit that people need to be aware of to understand the credit industry. Revolving credit, also referred to as consumer credit, is the most common form of revolving credit is credit cards. There's other types of personal lines of credit, but the focus here is to understand what revolving credit is. It's the type of credit that you can use, pay it off, and then use it again. Like you get your credit card, you have an available balance of $10,000, you can use it, pay it off, and you can continue to use it over and over again. As long as you're in good standing, the account is in good standing with the creditor, and the account remains open. Likewise, there's personal lines of credit where you have a checkbook, and you can literally write yourself a loan, pay it off, and then use it again, as long as that account is in good standing and an active open account. Then there's installment loans, or what are often referred to as fixed term loans. Car loans is the most common example of that, but what makes it an installment loan is you have a scheduled monthly payment and a set number of payments, fixed terms. Once you pay it off, the account closes, you cannot use it again. For instance, again, with car loans, you buy a car, take out a 60-month loan, for example, you can pay extra. You have a minimum payment, you can pay extra, pay it off early, thereby reducing your interest charges and saving money. But once the loan is paid off, the loan closes. Later, when you need to buy another car, you have to apply for, qualify, and take out a new loan. And then what we're focusing on much today is mortgages, which are like an installment loan in as much as they have fixed terms, often 30 years or 360 payments, a scheduled payment, fixed terms, just like installment loans, but these are specifically for the purchase of real property, most commonly a home, but then also for tracts of land without a home sitting on it. So how each of these can be affected by COVID-19. There's lots of ways that people's credit is being impacted by the COVID situation. The biggest thing is due to unemployment. There's I think it's approaching 30 million people have become unemployed in the last 5 to 6 weeks as a result of COVID. And then many, many other people are on reduced hours and thereby reduced incomes. And the effect of that, there's two main factors that we're seeing our clients are being affected, their credit's being affected by this. The first is missed payments. In the credit industry, that's often referred to as 30-day lates. This affects all three, and that is simply you're not making your payments. Either you're trying to pay reduced, you don't have enough money to pay what is the minimum scheduled payment, or not making a payment at all. And there, a little mystery as to what a late payment is. Your credit card companies are notorious in car dealerships, mortgages. They will all actually charge you a late fee when you're somewhere between 10 and 20 days late, depending on the account. They can charge you a late fee, but it doesn't show up on your credit report. In order for it to be an actual missed payment, where the 30-day late comes in to play, that is, you're making a payment after the next scheduled payment is already due. So you're a month behind. And then, of course, a 60-day late would be you just haven't made a payment in 2 months and so forth. This affects your payment history. And keep that in mind when we go to another slide. We're going to talk about what makes up your credit, and we'll refer back to these as how impactful your payment history is on your credit report. And then there's the increased debt load that many, many millions of Americans are taking on. As a result of being laid off, reduced hours, reduced income, many people are buying things today using credit cards that they would never use credit cards for. They're buying their groceries, they're paying for gas, they're paying for the absolute necessities that they would normally use a debit card, write a check, or perhaps use a credit card for convenience buying purchases, but then pay it off at the end of the month. But what's happening is, because of the reduced income, they're not able to pay these accounts off, and they're getting an increase in their debt load, and that's affecting the outstanding debts. So to understand how that all relates, how these issues affect you, you really have to understand what makes up a credit report. And even before I go into that, people have questions of us all the time. What exactly is a credit report? Here are these numbers. In the mortgage industry right now, most loan officers are wanting to see a 640 to get you approved. Our loan expert is able to get clients approved at 620. But what does that mean? What a credit report is, it's a score using algorithms that take a look at what is your pay, all these factors, and we'll talk about each one individually. But it looks at all these factors. What is your income? What is all these debt to income ratios? That just means how much debt you have, your monthly payments versus what your monthly income is. Mysterious terms, again, that are used in the credit industry. But it takes a look at all of those things, and their algorithms track individuals that have this much income, this much debt, this much negative history, positive history. What is their likelihood of success or failure in paying off a loan if we give it to them? And then they give you a score between 350 and 850, with 620 right now for our primary lender to be able to qualify you for a mortgage. Well, the 5 things that factor into that are recent inquiries. We get asked often, what is a hard inquiry? What is a soft inquiry? The difference is, a hard inquiry is you actually applying for credit. If you go to somewhere like Credit Karma, annualcreditreport.com, any of the monitoring systems, and you pull your own credit report to see what your score looks like, what's on your credit report, that is a soft inquiry. That doesn't affect your score, nor do any lenders that you may apply with in the future see that inquiry took place. It doesn't count as an inquiry. But if you're applying for credit, that is an inquiry. There's another form of soft inquiries that people often ask us about. They see on their report that they have an account with Capital One. They have a credit card with Capital One, and they've had it for years, but once a year or every 6 months, they show up on the credit report, Capital One checking your credit. That's a soft inquiry. That's your current creditors looking to see if your credit worthiness has changed. Sometimes you'll have a credit card and they'll increase your balance, your available credit. Sometimes they'll decrease it. That's because as they take a peek at what you have going on, they see that your credit status has changed from what it was when you first applied. And they modify the available credit that they are extending to you based on what they see. But again, the only inquiries that count are when you're applying for credit. They stay on your credit report for 2 years, but as far as affecting your credit, they look at a rolling 6-month window. So when it says recent inquiries, how many times have you applied for credit in the last 6 months? Now, where you can control this to lessen the effect of the impact of inquiries is shopping smart when you're shopping for things that credit's involved in. For instance, car shopping. We have clients that go to 5 dealerships, take 5 test drives, and fill out 5 credit applications at all 5 car stores before making the decision which car they want to buy. Each one of those becomes an inquiry. Do your shopping, pick the car you want, and apply for the credit at one store and one store only. Now, they're already going to check it at least twice because the dealership's going to check it, and then they're going to send it to an investor, the lender that you will eventually be financed with. So there's already going to be 2 inquiries. You don't want to be having your credit checked at every car dealership when you're shopping for a car. Then there's the types of credit in use. These first 2 are both 10%. That is a mix. They're looking for a mix of the 3 types of credit that we just talked about: revolving credit, installment credit, and mortgage history. Now, another part of the mystery in credit reports that most people don't know is every one of the credit bureaus, Experian, Equifax, and TransUnion, actually have 3 credit models. So if you're applying for revolving credit, if you're applying for a new credit card, they look at you using what they consider the revolving model, which means they more heavily rate your payment history as it applies to revolving. If you're buying a car, they look at your installments, so your previous history of installment than what you've paid on credit cards. And then, of course, if you're applying for a mortgage, they look at your mortgage history. This is where, if you talk with your mortgage loan officer, if you've never bought a house, if you're a first-time home buyer considering buying a house, and they talk to you about first-time buyers programs, that's where they come into play. It's kind of hard to have your mortgage model more heavily weighting mortgage history when you don't have any mortgage history. So they take that into consideration, and they have the first-time buyer programs to help you get a mortgage even though you don't have any mortgage history. That in recent history counts for 10% each. Then there's a length of credit history is 15% of your credit score. Not a lot you can do to control that other than this. If you have cards, a credit card or something that you opened up when you were 18, 19, 20 years old, if you went to college, the first time you walked across the campus, you were hit up with Discover or Capital One somebody. It's hard to walk across the college campus in the fall and when the freshmen are just starting to go to school and not have somebody offering you credit. We've all seen that. We've all had that. Well, don't close those accounts. We have clients very often 35 years old, and they've had this account for 15 years or something, and they decide, I haven't used that card, I'm not using that card, let me close it. Well, that reduces your credit history. So you don't want to close the oldest credit cards that you have. They show that you have long-term established history, and that's 15% of your credit history. Now we come to the big 2. Remember the previous slide? Those outstanding debts? That's your debt load that we talked about with the credit cards. If you're finding yourself having to use credit cards to get by right now because of unemployment or reduced hours, reduced income due to COVID, I understand that, and you just got to do what you've got to do right now. But with your credit cards, if you're using more than 30% of the available balance, meaning if you have a $10,000 credit card and you have a balance on it of $3,000 or more, meaning you might have got your statement and had $3,500 on it, you're paying $500, leaving $3,000 that's going to report to the credit bureau as an outstanding balance. That's 30%. 3,000 is 30% of a 300 rather. 3,000 is 30% of 10,000. That's going to hurt your score. And every step above 30%, your score begins to plummet. But again, we're in unprecedented times. So if you're having to do that, that's fine. Make your payments, even if it's just a minimum payment, and allow the debt to accrue. But know that when this is all over, to get your credit score to go back up, you're going to want to pay those credit cards down as quickly as you can. And then payment history. 35%, the biggest impact there is on your credit score, payment history. This is where those missed payments, those 30-day lates, skipped payments where you didn't have any money, you made no payment. This is where they fall, and they're the biggest hit there is to your credit card. So you want to be making your payments. If we talk about go to the next slide, the goal in this crisis, guys, is to protect your credit score and thus your financial future. And when I say your financial future, it's not just, your credit score is not just your ability to buy a car, to buy a home. People look at your credit score for insurance. People look at your credit score, many employers and those that might be unemployed right now and going to be reapplying for a new job. Many employers look at your credit history as part of the interview process. If you're not making your payments on time as scheduled, it means they look at it as your commitment to do what you said you would do. You made a commitment to make a payment of $700 a month on a new car for 5 years, and you dropped the ball, you didn't make those payments. To lots of employers, that has an impact on how they feel the type of person that you are. So if at all possible, make all of your payments on time, even if you're just making the minimum payment. If you have that credit card, like I have one that I use for convenience buying. Every time I go to the grocery store, every time I get gas, I have a credit card that I use, and then I pay it off every month. I just use it for convenience buying instead of carrying cash. I happen to deal with checks, archaic way to pay people. Pay, it seems, now in the 21st century. But if you have to go to just minimum payments to be able to get by through this struggle, do that. But then, as I said before, is when you're able to start making bigger payments, get it paid off, get that load reduced, and your score will go right back up. Now, if that is not possible, if you just can't make your payments, the most important key is communication. Talk to your creditors. Don't hide. Don't avoid their calls. In fact, honestly, don't wait for them to call. If you're not able to make your payments, call your creditors. They are aware of the crisis. They know what's going on, but they've got to hear from you. They don't know if you're part of that 25 million people that have been unemployed, or if you're one of the fortunate that are able to keep working and your income's not been affected. So if you don't communicate with them and don't make your payments, they are going to report it as a 30-day late and have a negative effect on your credit. All three types of creditors in all three facets of the industry have things that they can do to work with you. They can opt to allow you to defer some payments. They can opt to allow you to put off payments. Now, there is a danger in this that we want you to be aware of. Make sure you know what they're doing. They may say, okay, we're going to let you skip 3 payments, but 4 months from now, they want all 4 payments to be made at one time to be caught up. Or they can take those 3 payments and put them at the back end of the loan. And 4 months from now, you start making your regular scheduled payment. And now that you're back to work, you just have your regular budget, as opposed to all of a sudden you've been not working for a while. Now you have to make 4 payments at one time. But again, they have to hear from you. The one solution we hear the most questions about is the forbearance. What exactly is it? Forbearance mostly applies to the mortgage industry. It just provides a temporary relief by allowing you to make lower payments or no payments at all for a specific period of time. And generally, it's requested by homeowners dealing with an event such as COVID, where you just can't make your mortgage due to job loss, in this case, a national emergency. They can put you in forbearance, again, moving payments to the end of the loan. But above all else, once again, communication is the key. The mortgage company doesn't know you need a forbearance unless you call them and ask for forbearance. So again, not to be repetitive, but again, above all else, communication is the key. I hope you find that beneficial. I'm Steve Mills, president of America's Best Credit and Debt Consultants. This is our contact information. If you have additional questions or would like assistance with your credit, please feel free to reach out. Have a great day.
Gracias, Steve. Thank you so very, very much for this information. This is such wonderful information at this critical time, and thank you for all the resources. This has been a great virtual masterclass, and you've been a great part of this program. So thank you so much for all this. Have a great day. Stay connected with the Power on Heels Fund, Inc. on all our social media platforms, and visit our website at poweronheelsfund.org. Stay informed and plugged in on all our efforts and all our events. The COVID-19 Financial Summit Masterclasses are filled with industry experts and change agents sharing information to help you create smart financial strategies during these difficult times. Gracias and thank you for joining us. And remember, you are power on heels.